Craig Hodges, Hodges Fund CEO, telling us where he's putting his money to work. Christian Magoon, Yield Shares CEO and founder, on how he's playing the bond market. And Larry Shover joining us from the pits of the CME. Larry, I want to start with you. Are you a believer in this market, Larry? It seems that we are divided more than ever between those who say, look, we're going to continue to go up 10%, and those who say expect another correction.
You know, I do not expect another correction. In fact, I am a believer. My end target for the year is about 2,000 in the S&P 500. Right now, it's an important stage in our environment. I mean, right now we're digesting, we're consolidating. Traders want to know how we're going to negotiate that 1850 space. Very, very important. But let's keep in mind, to have a 10% correction in the market, we need to have some type of stretch valuations, which we clearly do not have, or some type of macro event, which I don't see in the cards right now.
Craig, you like the small cap space, small and mid caps, which have been beautiful performers. Certainly, all you have to do is look at the Russell 2000. But how long does this continue, and where's the most attractive part of it right now?
You know, the nice thing about small caps, I feel like there are always opportunities there. And so here at Hodges Capital, you know, we have more ideas than we have money. And we find every day new opportunities. And the thing about small caps, in slow growth environments, larger companies are looking for new growth vehicles. And so we've had several companies, even just this year, get bought out already.
Well, you like Signet, which, of course, that was the big deal recently with the Zales news. But, yeah. I mean, how many more of those opportunities are out there, in your opinion?
They are out there. You know, there's a lot of companies that we're following that think that in the next cycle, the peak of the next cycle, earnings can be 70 or even 100% more than they were in the previous cycle. And I think a lot of that is not factored in by the street. And
Christian,
so, we do see these opportunities.
Christian, you are one of those who think that the market's going to go up another 10% in the next 10 months. Why?
Well, I think there's plenty of room for this rally. I mean, sure, we've gone up about 170% since December or since 2009, but there's a lot of worries that are out there. We're not at a top where everyone thinks the geopolitical situation, the Federal Reserve situation, the monetary policy in the U.S. is all good. There's a lot of worry, and bull markets tend to climb that wall of worry. So I think we definitely have more upside of maybe as much as 10% going into the end of the year.
Hold on a second. You're saying we're going to move up 10% based on negative perceptions, based on just climbing the wall of worry? There's got to be something more substantive to your wishes.
Well, bull markets usually end in tops where there's consensus that things are going to continue to go forward. And we're certainly seeing with this last pullback some concerns that the market may be overvalued. And bull markets tend to climb this wall of worry. And I'm more interested that there isn't consensus, that we're going forward to new highs, that there's some tension here. And I think that alone, just from a technical perspective, bodes well for the market.
Larry, doesn't seem like there's a lot of fear anymore. That passed really quickly in January after the 6% decline. The volatility index is getting closer and closer to dipping perhaps below 14. What do you infer from that? Often when there's complacency, that's a market top. Do you believe that this time?
You know, I do, because I think what happened is we look at like the emerging market problem or the perceived problem, the debt ceiling, and also valuations. These were all manageable risks that we had to deal with. And in my mind, they were the three major drivers of us dropping 6% in the market. But then people realized that these were manageable things that could be taken care of. You couldn't paint the emerging markets with a broad brush, hence we go higher. Again, we are growing, revisions are going higher. Revenues in the last earnings season have been decent, not great. Growth metrics are okay, so I am a believer. I still think there's a lot of haters in this market, too many haters, and again, this wall of worries does make sense.
Indeed.
Craig, you make a lot of sense. You're looking for businesses that are established with a high barrier of entry. Companies, cement companies, for example, steel companies, airlines. Look for those companies that are already established that newcomers are not likely to get into.
Correct. That's a theme throughout our... And it's simply from making mistakes over the years of getting in hot industries that are too competitive. And there are a lot of industries, rails, and you mentioned the other ones, that have high barriers of entry. And when you have no competition, you're able to raise your prices, which of course helps margins. And you know, that's thing. Our favorite idea right now is American Airlines, one of them, and the street's way below what they're going to be able to earn once this integration of U.S. Air is complete. And there's many situations like that we see out there.
Well, Craig picks individual names like the ones on the screen. Christian, you go for ETFs, and in a way, I like the opportunity for ETFs because you can buy baskets of opportunity. But let's narrow this down. The dividend trade, for example, you still believe it's alive and kicking. Does it get better? And if so, what's the play there?
Yeah, Liz, I like really two different plays there, and I really like blending dividend income but with growth. So the first one is the First Trust NASDAQ Technology Dividend ETF, TDIV, and it's basically technology companies, telecom, traditional tech that are paying dividends. Yeah, the dividends aren't as high as some of the high dividend strategies, but you get that growth found in technology. The other is the Vanguard Dividend Appreciation ETF, VIG. This is more of a broad-based approach to companies that are consistently growing their dividends. Both of these dividend growth strategies will protect against potential rise in interest rates and inflation.
Christian, I got to ask you about emerging markets. You suggest one fund, Emerging Global Shares. Aren't you a little worried about emerging markets based on what's happened over the past couple of months?
Yes, I think there's definitely worries, and I think some of those worries have put certain areas of emerging markets on sale. I think you can't paint the brush totally and say they're all going down the tubes. This is an area that has a lot of opportunity. I like Econ. It's the emerging market consumer ETF, so it focuses on the leading consumer goods and service companies servicing emerging markets, and we know the middle class is growing there. They want to be like us, buy washing machines, have checking accounts, all those types of things. That's going to continue to be a strong play in the emerging market area.
Christian Magoon, Craig Hodges, and Larry Shover. Larry, we'll check back in with you in a few minutes for the S&P futures close. Thanks to all of you. Okay. Now let's head back to Larry Shover. He's in the pits of the CME. Hi, Larry.
Hello. You know, traders are really trying hard to hold on to their nerve because things do not make sense right now. We just crossed three formidable or potentially formidable headwinds in January, caused us to ratchet down and back up 6%. We have news out of Ukraine and Turkey, seems localized. Our economic data is marginal at best. However, we can climb higher. Things don't make sense. People keep thinking that 10-year yields are going to be 3.5%, yet utility stocks are outperforming the market right now. So I encourage everybody just to hold on to their nerve right now. Things are not collapsing. It's just cooling off right now, waiting for that next direction in the stock market.
Okay, calm your nerves, Larry says. Thanks, Larry, very much.
Calm your nerves. You're welcome.